This is Val Hughes of the Value Guys on the Financial Survival Network. Hello everybody, welcome to another edition of the Value Guys Stock Talk Show with the Value Guys. I'm Val Hughes.
And I'm Momentum.
And we are 31-year Wall Street veterans who have taken on secret identities and gone underground in order to provide you with a couple of ideas out of screens we run here in the shop each week. You've seen our faces on TV, you've seen us quoted in the news, but our bosses would never allow our unfiltered views on the air, so we've disguised our voices, and they'll never know. This week, we look at a screen that we run here in the shop. It's March 30th. We're doing a low price to book screen, stocks under 1.5 price to book. A pretty traditional value screen. But before we get to that, a couple of important caveats. First, this show is for entertainment purposes only. That's not a guarantee. Secondly, this is a hobby for Mo and I, so during the week we do a lot of careful fundamental research and talk to managers and operators and competitors. And here, of course, we do none of that. We're just hanging out after work. Third, our lawyers say to remind you we may not have your best interests in mind, maybe recommending you do the opposite of what's best for you, so please do your own work. And then fourth, I've been heavily drinking tonight. And Mo, you joined me this week. You had something, didn't you? Or you're not supposed to say that?
No.
On the QT?
No.
You got a game later or something?
Yeah.
Okay, yeah. No, Mo's not drinking. Okay. See all our caveats, indexes to past shows, best ideas, all kinds of things, photos, etc. at www.thevalueguys.com. Okay, we've got actually 4 terrific value ideas this week. And what we do here on the Value Guys Stock Talk Show, if I can learn how to say that, is we run screens that we just run here in the shop for paying clients that Value Guys tend to run. So I think if you go to our site, a few weeks ago we did a low PE screen. Again, very simple. The idea isn't to find the perfect stock with a screen. The idea is to get an inbox of stuff that you can look at, and go through the details. So 2 weeks ago, a low PE. Last week we did an enterprise value to sales screen. And both of those we put a little debt filter on. We've been using Yahoo Finance. They have a free screener that's amazing. The detailed one is for Windows. They've got one that's a little more simplistic for Mac, but it's free, so it's kind of cool. And I just ran that on that this week. So it was a price to book below 1.5, and you can run the screen yourself in Yahoo Finance. And then we looked for market caps under 2 billion, Mo. So
right.
That's the small cap zone to buy. We might own it to 5 billion. And then the other screen filter we threw on was debt to equity. I prefer to filter on debt to capital, but this particular screener didn't have that choice. So, but debt to equity less than 2.
Right.
And where's that list? I was showing. We got about 30 names came out of that. That's not it. Here we go. 30 names, and there were actually several names that came out were investment trusts. So I'd look at those independently. I didn't want to really weigh in on those because you got to go see what they own and things like that. And I'm trying to spend as little time as possible on this. So, but Royce Value Trust, I did a price to book screen. It's trading near book, so book should be liquid value. So maybe worth a look. They've got a Templeton Global Income Fund in here. These must be, I don't know if they're closed-end funds. I'm not exactly sure what these are. Trusts and things. You have to go figure that out. But and then there's a BlackRock product, municipal.
And they never traded meaningfully below their net asset value.
Well, I mean, I ran the screen below 1.5, so they could be at, maybe this is where they trade.
Right.
20% premiums to asset value or something like that. But anyway, there's a few of those. There's a couple names we've talked about in the past. Limelight Networks passes that screen. There's one I know we talked about recently. Anyway, it's a good screen to run, and we've got 4 names we're going to look at out of there. American National Insurance, ANAT, life insurance company. Fred's, ticker FRED, kind of a convenience store in some markets. LB Foster, FSTR, they're a fabricator of products for rail and construction markets. And then I'm not sure how to pronounce this, Mo.
Viad?
Viad. I'm not sure. Does it say where they're at? They're in Phoenix. So who knows how they say that in Phoenix? It could be an Indian word. But I thought this was very interesting. It's an ad and event firm.
Right.
So,
right. Well, you know, because you're a value guy.
Value guy, yeah.
You've got those value screens, but since
Same.
I'm a performance guy, I
You
screen. Yeah, we do screens for stocks that go up. So we do. You know, we really don't care so much about the value.
Right.
Stocks that go up. We get 5
Yeah.
of those, and they
Why
go
do you
up.
want stock? So you completely exclude the ones that go down then?
That's what
Just
we do.
right off the get-go.
It's actually it's a great.
Does that work,
strategy.
really?
Yeah. Yeah.
Clients aren't concerned that none of their stocks are going down? That doesn't bother them?
No. It's it's how we're outperforming. But that's what we do. That's what we screen for.
And
We should do a show with that next week.
That one's not on Yahoo Finance, though, Mo.
I'll bring it in. It's proprietary.
I must be. Okay, well, we have that coming up in a minute, but I want to. And then I have this segment that actually several people wrote in and liked called Paging Through National Economic Trends. So I wanted to do that.
Is it true that you read the kids this at night when you come home from work?
We do go through a little bit of this, yeah. I mean, they love it.
Yeah, it's like their
They love
bedtime story.
Yeah. No, they're eager to hear this when I get home. But sadly, a lot of times they're asleep when I get home. They didn't used to be, but once I started reading this, Mom says they're asleep. I'm like, what? Let's wake them up for this. But no, they don't want to do that. So, okay, where are we here? All right, we're getting to the segment I like to call
National Economic Trends.
Walking Through National Economic Trends. Okay, this is the March 2012 edition. This is stuff out of the Federal Reserve Bank of St. Louis. And anyone out there who wonders what's going on in the economy, where do I get that information, etc., it's all here. Now, a lot of this is cobbled together from other original sources that they find, and they tell you what a lot of them are, but it's all here. And then there's a companion piece called National Monetary Trends, which you can also look at, and maybe we'll do that one next week. You know, I don't know. But I had 3 charts I wanted to talk about this week. Just paging through. You want to page through with me, Mo? I got you a copy. Did you pick it? Here it is.
Oh.
Yeah. Got you your own copy.
What page are you on?
Oh, I'm on 7 now. I'm just paging through National Economic
I thought you
Trends.
had picked 7 already.
No, I'm on
3
7. I'm on page 7.
There we are. Yep.
The yield curve, you're just paging through. Oh, wait a minute. Now, here I am on page 8. I've circled something. Let's take a look. Let's dive in. What do we have here? Well, one big concern for investors, certainly in the bond market, is yields. And I didn't talk about it this week, but, you know, the long bond is at 2%. The short treasury is at, 0. We've had some bankers in here, and while things don't look great for banks, one thing they do have is free money from the government, so 0%. And so there's a concern about inflation. You know, the Fed has been pumping money out. If we do a thing on monetary trends, we're going to have some scary numbers to talk about. But so I thought, well, why don't we just talk about what the actual consumer price index is? Here's the number. It's right here. We don't have to guess, Mo, what inflation is. It's printed right here.
I'm looking at it.
Yeah. So this is like a 25-year chart, I think, going back to 87 if I'm doing the math. And I just want to say it gives you percent changes from a year ago. The darker line is all items. So let me talk about that first. All items. We did have a brief deflationary period during the recession, or the Great Recession as we're calling it. And that was the first recession on this page that actually saw deflation. during a recession, so that was something new. But right now we're sitting at about, off that low, we're sitting at about a 3% year-over-year change in the consumer price index. 3%. And when I look through this chart, I'm just going to draw a line here because that's how serious analysis works.
3%?
Yeah, 3%. And you see, that's right about at the average of where the consumer price index is over 25 years. Now, clearly that line could keep going up or it could go down. That's always the case. But I'd say right now it's not looking particularly scary.
Right. Right.
But wait till next week. The numbers next week will be scary. So that was on page 8. All right. Let's get back to paging through. We might need a little paging music for next week, you know, like on Jeopardy or something, you know.
Dum, dum, dum,
Dun, 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 dun. Yeah, let's see here. Oh, here we go. So I'm paging through. Page 12. Okay. Real consumption. Now, there was some concern during the downturn that people weren't spending money. And again, just like we saw deflation in that period beginning in the latter half of '08 and through all of '09, real consumption year over year was negative. Well, now we're positive again. Yeah.
That's what that means. Real consumption.
Yeah, I think, yeah. Why? Do you have an alternate?
No, I thought that was how much people were eating.
Well,
because
it probably
the
also
country's
is that
becoming larger and larger, and I looked at that graph and I thought, consumption, yeah, maybe that's what that graph is about.
Well, if everything were food, that is true.
Yeah.
Yeah.
Okay.
So, but the point, we're now at, again, you look at this year over year, the line is at about 4%, which when I, again, using some pretty serious analysis here, draw a line going all the way back 25 years, I'd say that's a little below the long average of the 90s, but it's about in sync with the
2000 and
decade.
2006, yeah.
So in other words, not far from what we should all expect. So real consumption, not scary right now. No, we're kind of back. Then I had another one on this page which makes the same point. Retail and food services sales. So if people are hunkering down, making their own food, making their own clothes, it's not going to be in this line, right? People will not be doing this. But in fact, over the last few months, the year-over-year percent change in retail and food service sales is 8%.
And it's been pretty stable at 8%.
And it's been, for about over a year. And if you look back, again, over 20 years, that's about as good as it ever gets. So while they talk about a jobless recession and all that, it hasn't been a foodless or retail serviceless recession, because this thing's coming on strong. Okay. I think I have one more, and I hope I'm not wasting everybody's time. Let's see here. The longer I take, the happier my kids are, because the lower the chance they'll have to actually listen to this, right? Okay, one more.
They can listen to the show.
Yeah, they don't, though. They don't listen to it. Okay, page 18. There's just a chart here, and this is a point I want to make. You know, a lot of people, including myself, gas prices. What's going on with gas prices? Well, they're up a lot. Or are they? And the reason I say that, ladies and gentlemen, is on this page is a graph of exchange rates. And, here's the thing. When you put out treasury bonds that yield 2% to the rest of the world, they say, okay, well, we'll take that percent, but we're going to take our other 6% by devaluing your currency. And that way, no one will really notice it. But if you look at this chart, since '01, now this happens in different times. It's kind of moves away around, but since '01, the exchange rate has been going against America, and this is just a major currency chart. So let's just say, here we go, major currency index. 25 years ago, it was, let's see, it was your typical major currency, whatever, was at 110, and that means the dollar was at 100. So you have a dollar, they have 110. So if you give them a dollar, they give you 110 back, and now you have 110 to go spend in their amalgamated country. Now, 2012, when you give them your dollar, again, it still seems like the same dollar to you, but they're only going to give you about 60 of their units back.
It's at 61.
61, yeah. And you're going to go, well, what's going on? And they're going to say, well, your currency's been devalued. And so when you think of a barrel of oil or a gallon of gasoline, $4 or $4.50 or whatever prices are wherever you may be. And I don't drive, so I don't know. I take a train, but let's see here. A gallon that's $4.50 today, at 60. You go back here, it was $1.20 not that long ago. Like in 2003, that would have been $2, $2.25 a gallon. So in other words, the rest of the world paying in a basket of currencies is not actually seeing increases in the price of oil. We are seeing increases because actually the oil is still the same, the dollar is getting less value. Yeah. And what's happened is as the deficit and concerns about the debt being paid and the interest being paid, work their way into world markets, the way it manifests itself is through this constant pressure on the dollar. So that's on page 18 in Walking Through National Economic Trends. Okay, so let's get right into a couple of stock ideas. Wow, we're well into the show and we haven't even started our stock ideas. I'm so sorry, ladies and gentlemen. Hopefully you fast forwarded to this point. 4 ideas. First up, alphabetically, American National Insurance Company, ticker ANAT. Now remember, this is a screen, a price-to-book screen, so every stock we talk about today is under 1.5 times book. This one is 0.5 times book. Now, we've talked about life insurance companies in the past, particularly coming out of the downturn. There were some good yields and some good valuations here. These guys have yet to really participate, and I think it's because their returns have stayed low, although they've been improving for a couple years. And I did some comparables. I'm honestly not quite sure why this is at such a big discount to book. It almost suggests that the market believes there's still some bad investments in here, and I can't speak to that because the page I'm looking at doesn't tell me, the age of the receivables or what the rating or the price of the bond portfolio is and things like that. So I don't have a lot of credit information here, but I just will say that in a market that trades at about looks like about 12 or 13 times earnings, this guy's at 10 times. Price to book on average for life insurance industry is 0.7. This is at 0.5. They're a little light on margin, so you're going to want to check into that. But I think it may be that their portfolio is less risky, and that's why they're earning less. In the case of banks, sometimes when the bank has a lower return in these days, that's better because it's a better portfolio. When I look at the analyst coverage, there's there's 0, and so that might explain some of this evaluation. There's competitors like Prudential Financial that trade at near book. Allstate trades near book. It could be that American National is doing business in a little niche or in a little territory that, because Prudential and Allstate can't grow, the CFO decides, hey, we want to show growth for our shareholders. Let's buy this little company. We'll get some sales growth. So it could simply be that. And their margin's a little lower because they're small, but if they get bought, they'd come in at a higher margin because there's duplication of costs, and the buyer would eliminate that. So I think this looks very interesting. You get a little bit of a yield. Let's see where it tells me that.
It's actually a 4.2% yield.
4.2. Okay.
Yeah, it's not bad.
So anyway, I don't know much else about it, Mo, but that's where I'm at on it.
Well, the new the new investment technical term everyone uses is meh. And that's
Yeah.
what I would. That's honest. That's what I come away with when I'm looking at America. It's like, Here's a real question. This stock is severely underperformed in each of the last 2 years. It was down 28% 2010 and 15% 2011. It's just not participating. You're right, but I'm wondering, is there something with Obamacare legislation that could affect the whole industry? Obviously, somebody knows something that's not good. Otherwise, I'd say, it's flat sales for the last 5 years. They've paid down their debt.
Yeah, I saw that.
Margins have been pretty consistent, so your dividend's safe. So 4% dividend yield, that's pretty good. But I'm a little scared by what I'm seeing with a very complex industry, where I'm seeing a bad stock price trend. I mean, I don't know. It's not the industry that can afford that, especially when you've got flat sales. You pretty much got flat margins. You just want to preserve the dividend. So if there's something regulatorily that's going to happen, I'm scared. But at any rate, nah.
Well, all I'd say to that is zero analysts covering it is sometimes,
I know.
It means, is it there's something missing, or is it the thing missing is that the information in the marketplace?
So if a tree fell in a forest and no one was there,
it would sell at half book.
Would it make any sound?
This one is not making a sound. All right.
Getting kind of philosophical.
Yeah. So
Fred's.
Let's see here. Fred's. Yeah. Fred's. Okay.
You shop there.
I have shopped there, but that was.
Is that a Fred's tie? Yeah, it is.
Yeah.
It's a Fred's tie.
When you go there, I was covering it at one time, and you get a discount on stuff, so I couldn't pass it. What do you think? It's kind of nice floral.
Looks sort of free.
Thank you. It was not free, my friend.
Well, whatever. Yeah.
Yeah. No, this was. Anyway, Fred's is they've got a bunch of discount general merchandise stores, and I don't have a map here, but they're mainly in the South. They were founded in Memphis, Tennessee. So if you start drawing circles outward from there, that's kind of where they are.
And they say they cater to low, middle, and fixed income people, which is 87% of the country. Because there's them, and then we're the 1%.
Yeah. No, they cater to the 99%.
So it's a big market.
Big market. Now they are located in small and medium-sized towns, so not big towns.
Right.
Small towns.
Right.
Small towns. And I remember these guys. The thing about this industry is, it's operating under a sort of a Walmart price umbrella. If you sell stuff higher than Walmart, people won't come in your store. So you got to sell stuff below Walmart, and as a result, you got to be really careful about your cost structure and what you buy. And part of the way they deal with that is they have very low cost real estate in off locations, and then they generally don't have a lot of they just have the bare minimums of what they need for technology. In fact, this is a long time ago, but let's say 15 years ago, I was covering this industry, and I remember it was Fred's, Dollar General, and Family Dollar. And you can go, Family Dollar and Dollar General were really the leaders, still are, and they had almost identical statistics for 20 years. And I remember going to an analyst presentation, and they were going to roll out some new technology, because they wanted to get ahead of the other competitor. And so we're all, there's computers now and stuff. Who knows what they might have? Well, the new technology was freezers. Yeah, freezers. If you put those freezers up in the front, it draws more people in your store because they want a cold beverage. And they'd never had a refrigerated item in their store before. So that was, you know, they have those banners of what's coming up next. That was the new technology. Now that was 15 years ago.
I thought that was in 2010.
Well, that might have been Fred's, because this new technology was coming from that was Family Dollar at the time. Now, something I'm remembering about Fred's, but it's not saying it here, so I'm just going to throw it out there because I'm trying to remember what was it about Fred's particularly. And I think what it was particularly is I believe they might have a little pharmacy in their stores as a way to, you know, how do you keep people coming back into your store? You want them to come and you think of a 7-Eleven, but where you can buy socks. That's not as expensive. So it's small. I mean, I think these stores are, doesn't say here, but I'm going to say 2,000 square feet or something like that. And you can buy your, you know, your needs in there. And they keep costs low. Now, these guys are putting up a single-digit return on equity. I know that Family Dollar and Dollar General for years were well higher than that, and even on this comp page I'm showing Dollar General's at 18%. So, you know, Fred's is on a much smaller footprint. Again, I'm not seeing it right here. I'm doing as little work as possible, but I don't see the number. But these guys have, I'm going to guess, 500 stores. I'm not, that's just off the top of my head. I'm not seeing it. Whereas a Dollar General or Family Dollar, those guys have thousands of stores. So Fred's isn't going to have the economies of scale that Family Dollar or Dollar General are or do have. And so one of the backdrops to Fred's is always that one of these guys might buy them, just that Fred's is in an area they're not, or there's overlap, or maybe Walmart would buy Fred's as a way to get into, you know, that smaller footprint store that they ought to be thinking about. So Fred's just kind of putters along. They do 4%, 5% EBITDA margins. That's in line with the other companies. And it trades at, you know, I already said it's trading at, you know, 1.3 times book, but a better multiple for me is 6 times EBITDA. That's a 16% cash-on-cash return. And, you know, I don't know how much growth you're going to get, but I'll say that over the last 10, 20 years, these discount stores are growing a lot faster than other kinds of stores because people want a good value. So I'm going to throw it out there. Fred's, ticker FRED.
All right, explain this to me.
Yeah.
Company is a 540 million market cap. They do a couple 100,000 shares a day of average daily volume. 11 analysts.
Well, I think those are the guys that all hope to sell it to Walmart or somebody.
Oh, well,
that's what I think.
You see stuff like that, and it does raise a few flags. You don't get that many people. You know how that is? The director of research comes in and says, "Hey, I got a little stock. You're just the guy to follow."
Yeah, exactly.
And why do I want to follow this? Just follow it.
Well, there's another reason, though, too. Family Dollar, which went private, I think, a few years ago. Dollar General is a huge stock. So maybe if you're following Dollar General, you kind of have to follow Fred's, too. That could be the reason. All these same 11 guys are actually also following Family Dollar. But, you know, all these stores are changing up. You know, Walgreens is going through a reformatting right now. CVS continues to push the envelope on, are they you know, what are they? Is it a pharmacy? Is it a convenience store? You know, there's a little bit of Woolworth, which for those of you that don't know Woolworth, it just means you're pretty young. But
I don't think there are any more
yeah,
Woolworths.
no, but I mean, the things that they sold, your socks, your candle, your eraser, you know, just wacky stuff that you need, you know,
Yep.
a comb. I mean, I don't know, you know,
Dental floss.
crazy things, a plant, you know. It's kind of an odd shopping list. You used to be able to get all that stuff in a Woolworth. A sandwich, you know, you could get that there too. And so I think that Walgreens, CVS, Fred's, I mean, they're all evolving, and I think there's room for Fred's to be something in that mix. So so that's Fred's. Okay, how much time do we have? We're taking a lot of the people's time here, Mo.
Well, let's go fast.
Well, we don't have to go fast. They can always just click off, right?
Oh,
Yeah, we don't have to.
There's an off button on our
or
podcast.
They can fast forward. It's like,
no, I didn't. I thought.
They can fast up, speed up. I have a button on my player where I could speed it up to 2 times the speed, but it doesn't make the voices go up in pitch.
Right.
Everyone has that, right?
Right.
So that's probably what people are doing right now. So these pauses get completely erased. You'll just flip it through. All right, what's the next one?
LB.
LB Foster. You know, it's fun to do these screens because I look back, if you pull our XML code into Internet Explorer, which is thevalueguys.com/thevalueguys.xml, this cool format pulls up in Explorer. Doesn't work in Firefox, Safari, or Chrome exactly, but you can enter a ticker and see which show over the last 5 years that it might have been discussed on. And it's increasingly been tough to find stocks we haven't talked about in the past, which is why we went to the small cap thing a few years ago. And so this one, it looked so interesting, and I remember the stock. I was sure we had done it, but we hadn't. LB Foster, FSTR, and I have owned this at times. I don't own it now. The thing that caught my eye, of course, is, again, the valuation. We did this price-to-book screen. This one is selling at 1 times book. So again, book doesn't mean a lot on some industrial companies unless the book represents the actual liquidation value of the net between assets and liabilities, which in a financial company like a life insurance company that we talked about earlier, it should be that. The regulators are trying to have it be that number. Here, of course, you got to look at return on equity as a guide, and we're in high single digits, 8-9%. And so that's why they kind of trade in your book, I think. But it is below their typical trend. They tend to trade between 0.7 and 1.7. Enterprise value to EBITDA, again, that's my favorite metric, 5 times. That's a 20% cash-on-cash return. So I keep looking. What these guys do is they manufacture, and I'm reading right out of the 10K, manufacture, fabricate, and distribute products and services for the rail, construction, energy, and utility markets. So that's right in the sweet spot of an economy that's bumping into capacity utilization constraints, and it's going to start growing. Rail's been in a capital spending period here for the first time in 100 years for the last few years. Construction's the one market that's got to turn. Energy, high prices attract activity, so we're going to be seeing stuff there. And utilities, again, just capacity constraints. So it seems like it's in a sweet spot. They've had, upper single-digit margins, pretty consistent. They didn't lose money in the downturn. They went right through that period. In fact, sales weren't even down at all during that. Or no, wait, I'm sorry. That's assets. Hold on. Yeah, sales were down. Pardon me. They were down a lot in 2009. So from 512 in 2008 to 382. But they've completely recovered. 590 this last year. And the analyst here is, or the consensus of the analysts is for just a effectively 1% growth for next year. I can't believe that's true, so you might want to check that. But they're broadly facing a bunch of industrial markets that are growing. It's 5 times EBITDA. It's got 3 analysts. So again, the thesis that companies with few analysts sometimes get mispriced because nobody's paying attention.
But I thought we just said companies with lots of analysts are sometimes mispriced because something's about to happen, and it's not built into the stock.
Well,
so you want to find companies with no analysts following them and lots of analysts following them.
No, I wouldn't look for one.
11 analysts following a 500 million company.
I think that's because of the Family Dollar or Dollar General, whichever one's public.
Yeah.
Yeah, I think that. Look, you're an analyst.
Something's going to happen with that stock. With 11 people on board, something's going to happen.
Something could happen. So. But let's say I come in your office, Mo, and I see your coverage list. It's been, you had a couple takeouts, a couple things didn't work out. You've got 12 stocks.
I need to add a few.
You need to add a few. And you're looking around, and you're already doing Fred's because you need a comp for Dollar General. Whoosh, tuck in.
Maybe.
I don't know.
Maybe.
I'll just say I might have done that at one point on a couple things. Anyway, all right, Fred's. Did you have any other comments on this? What's this? You
Forrester.
got some notes here.
This is Forrester.
Or I'm sorry, LB Foster. Did you have any other comments?
Yeah, the only thing I was going to ask you is take a look at what happened in 2011. The stock was down 31%. Now, it looks like it's recovering, but what happened? It looked like, the stock obviously got hit in 2008, 2009 recession. These guys are smack in the middle of the capital markets or the capital expenditure business. They had a really nice recovery stock-wise in 2010.
Well, it could have been this.
Yep.
Big earnings miss.
Big earnings miss.
Maybe.
Yeah. So what caused that? Or are they really poised for that kind of a recovery? But that would be the one thing I want to take a look at.
Yeah, good question.
And who's our next?
Well, the other thing I do say about here, this
Forrester?
one is that, on LB Foster, is I like their shareholders. You've got some pretty smart managers in here. Royce Special Equity Fund, and I'm not sure, I don't think that's Mr. Royce covering that there, but he has some smart team members, and that's a great firm, so who knows. But they have 9% of the shares. Keeley Small Cap Value, really good shop in the Midwest. They have 9% of the outstanding shares. Another Royce fund owns 2%. Columbia Small Cap Value, and I'm not sure, they own Acorn Fund now. I'm not sure who these guys are, but that's a smart firm. And then Vanguard, it accounts for about 20% of the holdings.
Yeah, that's a lot of smart money for them.
So I like that. All right, finally this week, a company.
We couldn't figure out how to pronounce it.
I don't know how to pronounce it.
Viad. Ticker symbol VVI.
VVI, yeah, which is.
And it's located in the VVI.
It is? What?
No, where it's underneath that's their ticker symbol is VVI.
That's their ticker symbol? Yep. Now, what are all these codes? That's their QSIP number.
That's what I thought. That's what I was looking at.
All right, well, again, this one came up because we got this list from the screen, about 30 names, and this is one that really caught my eye because I like what they do. It's unusual, and it's super important.
I couldn't figure out what they do.
Oh, God. Okay, let me just read this.
Yes.
Viad Corp, and I apologize if I'm mispronouncing that, which I probably am, provides exhibition, events, travel, and recreation industry services in North America, the United Kingdom, Germany, and the United Arab Emirates.
Well, now,
what is that?
Yes.
Okay, you're a company.
Yes.
You are inventing things, designing things, making things. The new product cycles in American and world business, for that matter, are getting faster and faster. You got to have stuff coming out. I don't know about you, but my phone, there's updates every day. If you're not making your product newer, better, faster every moment, then you're falling behind faster and faster. So as a result, the product launches are like Hollywood productions. You're coming out with a new computer, you need a show. You got a new car, show. You know what I'm saying? You got a new shoe coming out, show. You got a new stapler, show.
Got a new show.
Show. We didn't do the show.
We didn't do, yeah.
So they've got a team, just imagine, the lights, the stages, the girls, the glitter, the booze, etc.
Sounds like what we're doing right now.
Yeah, but we're just on a small scale here. We can manage this. If we scaled this up, invited all the listeners to a party, which
say we did it in the
kind
stadium.
of a cool idea, actually.
Yeah.
Then you'd want people to manage all that for you.
Right.
You know, the lighting, the catering, the logistics. We got people coming. We need cars. You need parking. These guys, soup to nuts. So the big wigs, they sit up in the big tower and they think of new stuff. And then you know what? Viad, one call. Hey, Viad. Yeah, handle it.
So
that's what they do.
So in theory, as the economy recovers, you have more lavish promotions. You go back to some of the old days of excess a little bit where these guys are going to get some of that spillover.
I'm saying a lot fewer launch parties at Subway where you can handle it yourself.
Right.
And more in venues that need managing.
Right.
And so, yeah, that's what I'm thinking is that as soon as people start feeling a little better, you know, we talked about this last week. Car sales consumer sentiment going off the charts. So does America want to party a little bit? You know, we've had this period of sadness.
Mourning. It's been mourning.
And it's been mourning in America, but the wrong kind of mourning, right? So I think that the stock market's doing a little better. You know, we're getting some little signs of improvement. More people at work.
Green shoots.
Green shoots, yeah. So I think that the next couple rounds of new product launches for big companies, I'm talking big Fortune 100 companies that do worldwide product launches, these are the guys that come and they handle everything so that at the end, people go up to the CEO and they go, that was pretty freaking cool. That was great, Marty. That kind of thing.
So what's the second business?
Second business?
One was face-to-face events, and then they've got a second business that does, I guess, opening of retail shopping malls and shopping centers, and they also do recreational tourism.
If you have it, they can open it. They can launch it.
Yeah.
Although, you know, they don't have any. I don't see any.
NASA
ship.
NASA should buy them because if they make it, these guys can launch it. I mean, it would save us a lot of money. It's a small cap company.
I was just
this is
say,
just government inefficiency.
There's no shipping or anything on here for these launches.
Yeah.
But no, seriously, it's brand optimization, and you're going to get these guys, and so. But I think that the market gets a little scared because back in 2008 they did $1.1 billion in sales, and then in 2009, when the good times weren't happening, they were down 30% in sales, and they lost money.
And it's been a hard recovery. I mean, sales have not exactly bounced straight back.
Yeah, no, right. They're still well off the peaks,
right.
Which I'd say for a lot of companies, you know, that have recovered, they're starting to get approach some of the old peaks.
Yeah.
And these guys are not. So I think that party feeling among corporate titans, you know, and remember now, people were going to jail for spending too much money or having lavish parties. Remember all that stuff, a Tyco and all that, and you know. So I think in general, or some guys got in trouble for eating shrimp at a party or something. Remember all those watchdogs or whatever? It's like, hey, that guy's having a branded scotch. You know, we shouldn't allow that.
How much was that?
Yeah, like wasting money. But in any case, if those good times come back, I think these guys could get involved. They're trading at 30% enterprise value to sales, when they traditionally trade on average at about, not a lot more, 0.4. That's not great. But their margin expansion, because as business grows, they've got a lot of fixed costs. All their incremental, is very high margin. And so
now stop on that point for 1 second. Here's something to look at. See these margins? Take a look down here, net margin.
Yeah.
They were as high as 6% back in 2008.
Yeah.
And they've gone down consistently 4%, 3.8%, negative 13% in 2009. Okay, but zero margins in 2010.
See, that's what I'm talking about.
So if it's structurally possible to go back to those older margins, that would be a huge margin expansion. I just don't know if the business has changed enough that those new much lower margins are the norm, or are they?
Yeah, well, here'd be my thesis on that, but you got to find this out, is that this is largely a group of very talented people who arrange things. They don't have factories or anything. There's no investment really to speak of, although there must be. They should have higher returns on assets and all that. But my guess is that, you know, this margin came down just in line with sales coming down, you know, and that if we can get back to these levels, the billion, that the margin will come back because they don't have as much incremental expense. So that's what I'm thinking. Who knows? So if that happens, right now this is trading at 6.5 times EBITDA. Again, that's about a 15% cash-on-cash return. And let's see what else. 13 times earnings. So that's not tremendously cheap. But I have to hang on this enterprise value to EBITDA because for businesses like this, it really is about cash flow. And the thought that you might get a little recovery coming down the road. The ROA, return on assets, return on equity, if you got to go back 8 years to get a decent return on equity, which is still not great, 12%. So I would say some of their assets here, I don't know what they are, but they're overstated, whatever they are. They're not really buying a lot of new stuff, but they could be depreciating the stuff a lot faster than they are. But other than that, as a caveat, I'd say I would own this for a pickup in sort of corporate business that's going to lead to a little bit more spending on the new launch side of things. And these guys look like an interesting way to play it.
And you get a 16-cent dividend.
Do you?
Yeah, which is a 118-year payback period. And I know for you as a value guy, that's probably within your parameters.
That's not too bad.
Yeah, we
you can will that stuff.
We only look out, a few hours.
So I guess that's all we had this week.
Whoa, we're out of time.
Did we? Wow, that show got long. I wanted to say a couple quick things before we ended the show. First was, during this stressful time here on the show, I just want to say thank you to Carrie Lutz, who has been real helpful in talking through some issues. He's got a pretty cool show here on iTunes as well called Financial Survival Network, so you can Google that up and check it out. But I just wanted to thank Carrie for his thoughts. And then I wanted to also say, and I don't usually do this, but just we've had some interesting conversations. I wanted to say good luck to James, and I'm not sure how to say this. I'm going to say Ulan, but it could be Ulan. We just email, and I haven't spoken to him. But he's trying to get a job in the business, and he's an NYU student, and we had a couple exchanges. And I just want to say good luck, James. I hope you get that post you're looking for out there.
I lived almost on the NYU campus in New York.
Yeah.
On 9th Street, do you remember?
Yeah, I was at your place.
So NYU owns that whole area of Greenwich Village. And they've turned a huge section of Fifth Avenue into dorms. So you have NYU students living in apartments that the market value is, $12 million.
Yeah.
So shout out to all of you NYU guys living on Fifth Avenue. That's probably the last time in your life you're ever going to live at that address.
At least for a while.
Because unless you are make it big in the business, so enjoy that address while you can.
Go to grad school for sure.
Yeah.
So. You've managed to waste another hour here almost listening to the Value Guys Stock Talk show, and I ripped that off just from Car Talk, so thank you to you guys. See all our caveats, all of our stock lists, links to past shows, pictures our moms took at www.thevalueguys.com. Thanks for listening in, everybody.
And have a good weekend.